Welcome to Part 2B of the CISA series, the Information Systems Audit Process. In this section, we focus on governance, the foundation of the internal audit function, and the importance of understanding the business environment before audits begin. We will explore how governance structures, professional standards, ethics, authority, and organizational objectives shape effective auditing. We will also examine how auditors develop an understanding of business processes, technology environments, risks, and stakeholder expectations to support risk-based and value-adding audit activities. This knowledge forms the foundation for planning, prioritizing, and executing effective information systems. This series follows the complete information systems audit process from governance and planning through to reporting and continuous improvement. Part 1 introduced audit fundamentals, standards, ethics, and the overall audit lifecycle. In Part 2, we focus on governance, the internal audit foundation, and understanding the business environment before moving into enterprise risk assessment, audit universe development, and strategic audit planning. Part 4 then explores individual engagement planning and audit project management. Part 5 covers audit execution, fieldwork, evidence collection, data analytics, and technology-enabled auditing. Part 6 focuses on evaluating findings, root cause analysis, and technology-driven audit techniques. Finally, Part 7 examines audit reporting, communication, follow-up activities, quality assurance, and continuous improvement across the audit function. In this section, we explore the key topics that form the foundation of effective information systems auditing. We begin with governance and oversight, including the role of the board, audit committee, and governance structures that support accountability and organizational direction. Next, we examine the internal audit foundation, including the Audit Charter, authority, independence, professional ethics, and the standards that guide audit activities. We then move into understanding the business context, where auditors develop an understanding of organizational objectives, business operations, stakeholders, and the internal and external environment. Finally, we look at risk and compliance context, including enterprise risk management, regulatory obligations, internal controls, and how risk influences audit priorities and assurance activities. Together, these areas provide the knowledge and structure needed to support risk-based, relevant, and value-adding audits. Understanding these areas is critical because they provide the foundation for effective internal auditing. Strong governance and oversight help ensure accountability, strategic alignment, and clearly defined assurance responsibilities across the organization. A well-established internal audit foundation supports audit independence, authority, objectivity, and consistent professional practices. Understanding the business context allows auditors to align audit activities with organizational objectives, operational processes, stakeholder expectations, and business priorities. Awareness of the risk and compliance context supports risk-based audit planning, strengthens regulatory awareness, and helps auditors focus on areas of highest organizational impact. Together, these elements enable more relevant, credible, and value-adding assurance activities. Effective auditors must understand the business they are auditing. Audit activities are designed to support business objectives, not just review technical systems or controls in isolation. Risks also differ across industries. What matters most in banking, healthcare, retail, or an ICT service provider may be completely different, which means audit priorities must align to the organization's environment and operations. Technology now drives most business processes, so auditors need to understand how systems support services, operations, customers, and decision-making. Controls are implemented to reduce business risk, protect information, support compliance, and improve operational reliability. Most importantly, auditors are not only auditing technology, they are auditing business processes, governance, risk management, and the effectiveness of controls that support organizational success. In this section, we begin exploring governance and oversight, and how these structures support effective internal auditing. We will look at the role of governance bodies such as the board and audit committee, the importance of accountability and oversight, and how internal audit fits into the broader governance framework of the organization. This foundation is critical for ensuring that audit activities remain independent, objective, risk-focused, and aligned with organizational goals. Strong internal audit functions rely on three key foundations: governance, authority, and a professional framework. This slide shows how the Board and Audit Committee provide oversight of the internal audit function, while the Chief Audit Executive leads audit activities and maintains independence from operational management. It also highlights the importance of authority and independence. Internal audit must have unrestricted access to information, systems, and personnel, and must be free from management interference to provide objective assurance. The professional framework section focuses on standards, ethics, competence, due professional care, and quality assurance. These help ensure audit work is consistent, credible, and reliable. At the center is the Audit Charter, which formally defines the purpose, authority, scope, responsibilities, and reporting structure of internal audit. Overall, these elements work together to support effective governance, strengthen controls, improve accountability, and help internal audit deliver independent, value-adding assurance to the organization. The Three Lines model is a governance framework that helps organizations clearly define roles and responsibilities for managing risk, maintaining controls, and providing assurance. The first line is operational management. These are the business and IT teams responsible for day-to-day operations. They own and manage risk, implement controls, follow procedures, and address issues as they arise. In simple terms, the first line runs the business and operates the controls. The second line consists of risk and compliance oversight functions. These teams provide guidance, monitoring, policies, standards, and compliance oversight. They support and challenge the first line to help ensure risks are properly managed and controls remain effective. The third line is internal audit. Internal audit provides independent assurance to the Board and Audit Committee regarding the effectiveness of governance, risk management, and internal controls. Internal audit does not operate controls or manage risk directly. Instead, it independently evaluates how effectively those activities are being performed. The slide also highlights why the Three Lines model is important. It clarifies accountability, strengthens governance, improves risk management, supports independence and objectivity, and helps organizations make better decisions. At the bottom, the diagram shows that assurance can come from multiple sources, including management, risk and compliance functions, internal audit, external audit, regulators, and certification bodies. Each plays a different role in supporting governance and organizational confidence. For the CISA exam, it is very important to understand the distinction between operating controls, overseeing controls, and independently assessing controls. That separation of responsibilities is one of the core principles behind effective governance and assurance. Having established the governance and oversight structure, we now move into the internal audit foundation. This area focuses on the elements that enable internal audit to operate effectively, independently, and professionally within the organization. We will explore concepts such as audit authority, independence, ethics, professional standards, responsibilities, and the Audit Charter that formally defines the role of the internal audit function. This slide shows how internal audit is structured and governed within an organization. At the top of the structure is the Board of Directors. The board is ultimately responsible for governance, strategic direction, oversight, and ensuring that the organization achieves its objectives while managing risk appropriately. Supporting the board is the Audit Committee. The Audit Committee provides focused oversight over areas such as financial reporting, internal controls, compliance, risk management, and audit activities. It also plays a key role in supporting the independence of the internal audit function. The Chief Audit Executive, or CAE, leads the internal audit function and reports functionally to the Audit Committee. This reporting relationship is extremely important because it helps ensure that internal audit can operate independently and objectively, without inappropriate influence from operational management. The slide also highlights the Three Lines model, which helps clarify roles and responsibilities across the organization. The first line is management, or operational management. The second line includes risk management, compliance, information security, legal, and other governance or oversight functions. The third line is internal audit. Internal audit provides independent assurance over the effectiveness of governance, risk management, and internal controls. Internal auditors evaluate whether controls are properly designed, operating effectively, and aligned to business objectives and regulatory requirements. A very important concept for the CISA exam is understanding that internal audit does not manage risk and does not operate controls. That responsibility belongs to management. Internal audit's role is to independently assess and report on how effectively those risks and controls are being managed. The assurance flow shown on the slide demonstrates how accountability moves through the organization, from operations to oversight functions to internal audit, and ultimately to the audit committee and board. Audit ethics are fundamental to the credibility and effectiveness of the audit profession. Auditors are trusted with evaluating governance, risk management, controls, compliance, and business processes, which means their work must be performed with honesty, fairness, professionalism, and independence. This slide highlights the core ethical principles expected from auditors, including integrity, objectivity, confidentiality, professional competence, professional behavior, and independence. These principles help ensure that audit conclusions are reliable, unbiased, and trusted by management, regulators, and stakeholders. The slide also shows some of the most common ethical threats auditors may face, such as self-interest, self-review, familiarity, advocacy, and intimidation threats. Recognizing these threats is important because they can affect an auditor's judgment and independence if not properly managed. From a CISA perspective, ethics are not just theoretical concepts. They directly influence audit quality, stakeholder confidence, and the overall effectiveness of governance and assurance activities. An audit charter is one of the most important foundational documents within the internal audit function. It formally defines the purpose, authority, responsibilities, independence, and scope of internal audit, and establishes how the audit function operates within the organization. The Charter normally explains what internal audit is responsible for, what access rights auditors have, how independence and objectivity are maintained, how audits are planned and performed, and how findings are reported and followed up. It also aligns the audit function with professional standards, ethics requirements, quality assurance practices, and organizational governance expectations. From a CISA perspective, the Audit Charter is important because it gives internal audit the formal authority to perform its work independently and effectively, while ensuring accountability to the board or audit committee. Strong internal auditing begins with effective governance, clear authority, and a well-defined professional framework. At the center of this structure is the Audit Charter, which formally establishes the purpose, authority, responsibilities, independence, and scope of the internal audit function. Governance bodies such as the Board and Audit Committee provide oversight and accountability, while the Audit Charter gives internal audit the authority to access information, communicate findings, and perform its work independently and objectively. The professional framework then ensures that audit activities are performed consistently and ethically through the application of recognized standards, professional competence, due care, and quality assurance practices. Together, governance, authority, and the professional framework create the foundation that enables internal audit to provide credible, risk-based, and value-adding assurance to the organization. Attribute standards and performance standards are two complementary areas within the professional audit framework. Attribute standards focus on the audit function itself and the characteristics auditors must possess. These standards address areas such as independence, objectivity, competence, authority, governance, and quality assurance. In simple terms, they determine whether the audit function is properly structured and capable of performing effective audits. Performance standards, on the other hand, focus on how audit engagements are actually performed. They guide auditors in areas such as planning, risk assessment, evidence collection, testing, documentation, reporting, communication, and follow-up activities. A useful way to remember the difference is: attribute standards focus on who performs the audit and whether the function is capable and independent. Performance standards focus on how the audit is performed and whether it is executed effectively and consistently. Together, these standards help ensure that internal audit activities are credible, professional, risk-based, and aligned with recognized auditing practices. Effective auditing depends on having the right people performing the right responsibilities throughout the audit lifecycle. This slide shows how different roles contribute across each stage of the audit process, from planning and fieldwork to reporting, follow-up, and continuous improvement. The Board and Audit Committee provide governance and oversight, while the Chief Audit Executive leads the audit function and ensures independence and alignment with organizational objectives. Engagement managers and auditors perform the day-to-day audit activities, including planning engagements, collecting evidence, evaluating controls, and communicating findings. Management and auditees support the process by providing information, responding to findings, and implementing corrective actions. In some situations, external auditors or specialists may also contribute expertise in technical or specialized areas. The key message is that auditing is a collaborative process with clearly defined responsibilities, where independence, communication, professional care, and accountability are critical at every stage. Before auditors can evaluate controls, risks, compliance, or operational effectiveness, they first need to understand the business itself. Business context provides the foundation for risk-based auditing. It helps auditors understand organizational objectives, governance structures, business processes, stakeholder expectations, industry pressures, regulatory obligations, and operational dependencies. Understanding the organization and its business context is one of the most important foundations of effective internal auditing. Without this understanding, auditors may focus on the wrong risks, misunderstand business priorities, or provide recommendations that add little value to the organization. The first area shown here is understanding business objectives and strategy. Auditors need to understand the organization's mission, strategic direction, growth plans, key initiatives, and performance goals. This helps ensure that audit activities are aligned to what matters most to the business and supports achievement of organizational objectives. The next area focuses on the internal and external business environment. Internally, auditors assess processes, systems, resources, organizational structure, and operational capabilities. Externally, they consider factors such as industry pressures, competition, economic conditions, technological change, legal requirements, and political influences. These factors often shape the risks facing the organization. Another major area is risk appetite and enterprise risk management. Auditors must understand how much risk the organization is willing to accept, how risks are identified and assessed, and how management monitors and treats those risks. This allows audit priorities to be aligned to the organization's highest risk areas. Regulatory and compliance considerations are also critical. Organizations operate within legal, contractual, industry, and regulatory requirements. Auditors need to understand which laws, standards, and compliance obligations apply to the organization and how management ensures ongoing compliance. The slide also highlights organizational culture and the control environment. Auditors assess the tone at the top, ethical behavior, governance practices, accountability structures, and management oversight. A strong control culture often supports more effective governance and operational discipline. Stakeholder expectations and communication are another important consideration. Internal audit interacts with executives, operational management, regulators, customers, external auditors, and governance committees. Understanding stakeholder expectations helps ensure audit activities remain relevant and valuable. Finally, audit activities must align with business risk. Auditors link organizational objectives, operational processes, and identified risks to develop a risk-based audit approach. This helps ensure audit resources focus on the areas of greatest organizational impact. The right-hand side of the slide explains why each of these areas is important for internal audit. Together, they help auditors understand opportunities, threats, control effectiveness, compliance exposure, stakeholder concerns, and emerging risks across the organization. At the bottom of the slide is the overall outcome of this process. A strong understanding of the organization and its business context allows internal audit to provide assurance that is relevant, risk-focused, insightful, trusted, and value-adding. This understanding ultimately becomes the foundation for the next stages of the audit process, including enterprise risk assessment, audit universe development, strategic audit planning, and prioritization of audit activities. The main output of understanding the organization and business environment is the ability to perform more focused and relevant risk-based auditing. By understanding the business objectives, technology environment, governance structures, critical processes, and regulatory obligations, internal audit can identify where the greatest risks and control concerns exist. This understanding helps internal audit determine what should be audited, where the highest risks are, which controls are most important, and where audit efforts should be prioritized. The outputs from this phase typically include risk assessments, the audit universe, stakeholder analysis, technology landscape reviews, audit priorities, and the development of the annual audit plan. In simple terms, better business understanding leads to better audit planning, stronger assurance, and greater organizational value. Now that we understand the organization, its objectives, operating environment, governance structures, and key risks, the next step is to transition into risk and audit planning activities. This part focuses on how internal audit converts business understanding into a practical, risk-based audit approach. Auditors begin identifying the organization's most significant risks, compliance obligations, critical processes, and high-impact operational areas. From there, internal audit develops the audit universe, prioritizes audit activities, aligns assurance work to organizational objectives, and creates strategic and annual audit plans based on risk and business importance. This transition is where understanding becomes action, transforming business and risk knowledge into focused, value-adding audit planning and assurance activities. Understanding the organization and its business environment is the starting point for effective risk-based auditing. Once auditors understand the business objectives, operations, technology environment, governance structures, and compliance requirements, they can begin identifying the risks that may impact the organization. Those identified risks then feed into the enterprise risk assessment process, where internal audit evaluates areas such as cybersecurity, operational risk, compliance exposure, and third-party dependencies. The next step is developing the audit universe, the complete list of auditable entities, systems, processes, and operational areas across the organization. From there, internal audit moves into strategic audit planning, where audits are prioritized based on risk, business importance, regulatory requirements, and available resources. The key message of this slide is that strong business understanding drives better audit planning. The better internal audit understands the organization, the better it can focus assurance activities on the areas of highest risk and greatest organizational impact. Let's now look at how the audit process is applied in practice within an ICT company environment. In this scenario, Tech Solutions is a mid-sized ICT services provider delivering cloud hosting, managed IT services, software development, and technical support services to multiple customers across regulated industries. The organization operates within a multi-cloud environment, supports a large customer base, and is subject to contractual, regulatory, cybersecurity, and operational obligations. The process begins with understanding the organization and the business environment. Internal audit meets with stakeholders, reviews documentation, analyses governance structures, and observes operational activities to understand how the company functions. During this phase, auditors identify the organization's core services, critical business processes, key technologies, major stakeholders, governance structures, and compliance obligations. For example, they may identify cloud hosting platforms, managed infrastructure services, change management processes, incident management, customer onboarding systems, AWS or Azure environments, SaaS platforms, and cybersecurity dependencies as key operational components. They also identify important stakeholders such as customers, employees, vendors, regulators, the board, and the audit committee. Once this understanding is established, internal audit moves into enterprise risk assessment. Here, risks are identified and evaluated based on likelihood, impact, business exposure, and existing controls. The slide highlights several examples of risks identified within the ICT environment, including ransomware attacks, cloud service outages, data privacy breaches, privileged access weaknesses, backup and disaster recovery failures, third-party vendor failures, change management issues, and regulatory non-compliance. These risks are then prioritized based on potential impact to customers, operations, reputation, legal exposure, and financial performance. The next phase is audit universe development. The audit universe represents the complete population of auditable entities, systems, processes, and operational areas within the organization. For tech solutions, this includes cloud operations, data center operations, network and security management, identity and access management, software development lifecycle processes, incident and problem management, backup and disaster recovery, vendor oversight, customer onboarding, and compliance activities. This step ensures that internal audit has visibility over all major operational and technology areas that may require assurance. Once the audit universe is established, internal audit performs strategic audit planning. Audits are prioritized based on risk exposure, business importance, compliance obligations, stakeholder concerns, and available audit resources. In this example, high-risk areas such as cybersecurity, cloud resilience, privileged access management, POPIA compliance, and backup and disaster recovery are prioritized earlier within the audit plan. Medium-risk areas such as change management effectiveness or vendor management may be scheduled later based on overall risk exposure and audit priorities. The slide also demonstrates how outputs from each phase become inputs into the next phase. Business understanding feeds into risk assessment. Risk assessment feeds into the audit universe. The audit universe feeds into strategic audit planning. And strategic planning ultimately drives audit execution. At the bottom of the slide is a practical summary showing how the process works in reality. Auditors interview engineers, review architectures, analyze incidents, evaluate SLAs, identify risks, prioritize audit areas, and allocate resources to the areas of highest organizational impact. The overall result is a risk-based audit plan aligned to business objectives, operational realities, compliance requirements, and organizational priorities. The key takeaway from this example is that effective internal auditing is deeply connected to business understanding. The better internal audit understands the organization, the better it can identify meaningful risks, focus assurance efforts appropriately, and deliver value to governance, management, and stakeholders. One of the challenges when studying for the CISA exam is that many concepts sound very similar, but actually mean very different things in practice. Understanding these distinctions is extremely important because exam questions often test whether you can identify the correct governance, risk, control, or assurance perspective in a scenario. Governance and management are commonly confused. Governance is focused on oversight, accountability, strategic direction, and ensuring organizational objectives are achieved. Management, on the other hand, is responsible for executing strategy, running operations, and implementing controls and processes on a day-to-day basis. There is also an important distinction between the board and the audit committee. The board provides overall organizational governance and strategic oversight, while the audit committee focuses more specifically on financial reporting, internal controls, audit activities, risk, and compliance oversight. Strategy versus operations is another key area. Strategy defines long-term organizational direction and objectives, while operations focus on the daily activities required to achieve those objectives. Auditors must also understand the relationship between business objectives and IT objectives. Business objectives define what the organization wants to achieve, while IT objectives support and enable those goals through technology, systems, and information services. In risk management, a risk is not the same as an issue. A risk is a potential future event that could impact objectives, whereas an issue is a problem that already exists and requires action. Risk and controls are also closely related but very different concepts. Risk represents exposure or uncertainty, while controls are the safeguards designed to reduce the likelihood or impact of that risk. Compliance and governance are often linked together, but they are not identical. Compliance focuses on adherence to laws, regulations, standards, and contractual obligations, while governance provides the overall framework for accountability, oversight, and organizational direction. Auditors must also distinguish between governance frameworks and control frameworks. Governance frameworks provide structures for oversight and decision-making, while control frameworks provide guidance on implementing and managing operational controls. Another critical distinction is between internal controls and internal audit. Internal controls are operated by management to manage risk and support objectives, while internal audit independently evaluates whether those controls are properly designed and operating effectively. Independence and objectivity are fundamental audit principles but are not the same thing. Independence relates to organizational structure and reporting lines, while objectivity refers to the auditor's unbiased mental attitude and professional judgment. Accountability and responsibility are also commonly confused. Accountability means being ultimately answerable for outcomes, while responsibility refers to performing the actual work or activity. Authority versus responsibility is another important distinction. Authority gives someone the right to direct or make decisions, while responsibility creates the obligation to carry out assigned tasks. The difference between assurance and oversight is also significant. Oversight involves supervision and governance activities, while assurance provides independent evaluation and confidence regarding controls, risk management, and governance effectiveness. Auditing and monitoring are related activities, but they serve different purposes. Monitoring is ongoing and operational in nature, while auditing is periodic, independent, and evidence-based. Business processes and IT processes are also connected but distinct. Business processes support organizational operations and value delivery, while IT processes support and enable technology services and information systems. Policies, procedures, standards, and guidelines are frequently confused in governance discussions. Policies define what must be done, procedures explain how tasks are performed, standards establish mandatory requirements, and guidelines provide recommended practices. Culture and the control environment also differ. Culture reflects organizational behaviors, attitudes, and values, while the control environment represents the formal governance, ethics, accountability, and control structure established by leadership. Auditors must additionally understand the distinction between regulatory and contractual requirements. Regulatory requirements are imposed by laws or regulators, while contractual requirements arise from agreements with customers, suppliers, or partners. Due care and due diligence are closely related professional concepts. Due care means acting with reasonable caution and professionalism, while due diligence involves ongoing investigation, assessment, and monitoring activities. The three lines model is another area frequently tested in CISA. The first line operates processes and controls, the second line oversees risk and compliance activities, and the third line, internal audit, provides independent assurance. Finally, auditors must understand the difference between business context and risk context, as well as strategic risk and operational risk. Business context focuses on the organization's environment, objectives, and operations, while risk context focuses specifically on threats, exposures, and uncertainties. Strategic risks impact long-term organizational direction, whereas operational risks affect day-to-day business activities. Understanding these distinctions helps auditors interpret audit scenarios correctly, communicate effectively with stakeholders, and perform more relevant, risk-focused, and value-adding assurance activities. In the next part of the series, the focus shifts into enterprise risk assessment, audit universe development, and strategic audit planning. The discussion explores how organizations identify, assess, and respond to risk, and how auditors evaluate the effectiveness of internal controls in supporting governance, compliance, and business objectives. The series also examines key risk management concepts, control types, control effectiveness, and the development of a risk-based audit plan aligned to organizational priorities and risk exposure. The information presented in this series is based on practical experience, professional interpretation, research, and industry practices related to information systems auditing, governance, risk management, and internal controls. This content is intended for educational and awareness purposes only and should not be interpreted as official guidance from any other organization or certification body. The presenter is not affiliated with any organization referenced throughout the series, and viewers should always refer to official standards, frameworks, and guidance publications when preparing for certification examinations or implementing audit and governance practices within their organizations. Thank you for watching the series. If you found the content useful, please like, share, subscribe, and follow the series for future topics on auditing, governance, information security, risk management, and compliance.